Hello everybody, welcome to OT Academy's webinar series and Online Trading Academy. We want to welcome you today to a great presentation because it's very timely, it's very current, and it's something that you might not be hearing about in mainstream media, but you should be very nervous of it, and that is a rising interest rate environment. I'm joined today with Bill Addiss, industry expert in bonds and commodities and options. He's all over the place.
All over the place.
Many years in the service industry. So let's start off by just giving a quick little disclaimer here. We are going to be talking about a lot of different topics today, mainly interest rates, the Fed, bonds, but we're also going to be looking at different investment vehicles which could be beneficial to you should we be, in fact, in a rising rate environment. So that said, we're going to start off with a little walk through history here. So just to set the stage of where we are, you need to look at this S&P 500 chart going back into 97. Of course, we could go back further, but let's just start there. What's important to memorize, to identify here is how we have had such significant moves and boom-bust cycles. So right here you can see we've got some percentages on the screen. We had a 51% decline from 2000 to 2002, 104% rally for the next 6 years, then a 57% drop, which a lot of people might have that fresh in their memory. What's interesting to note, though, is we've had a 330% rally from the bottom in 2009 to our peak just a couple months ago. Now, what is even more noteworthy is to look at what the Fed and interest rates do to help facilitate these market rallies, to help slow them down, and to help cushion a market crash. So here is the interest rate look, the picture of what the Fed has done with interest rates. And you can see that over the course of history, as markets are falling, they cut rates aggressively to help save the market. As markets are rallying aggressively, they raise rates to slow it down so we don't overheat. What I want to point out is what happened here in 2002 to 2007. We had a market that rallied 104%. The Fed raised 17 times, 17 times they raised rates to slow that down so it didn't get out of hand. In contrast, from 2009 to where we are as of this exact moment, we have raised, 5-6 times, and we've had a rally in the markets of 330%. So something is clearly wrong. Now, interest rates right now are where we see this horizontal line at, right at 1.75%, which is historically very low. I'll make the statement here that one of these kids is not like the other. Bill, tell me a little bit about this picture and what you perceive to be wrong with it.
Well, what's interesting to note in this picture, Merlin, is that in that period from 2009 through 2010, our Fed cut interest rates 13 times during that period of time, obviously in response to the recession. But what's not shown on this chart is what the Fed did starting in 2010 when that Fed funds rate got down to 0, which at the time we thought was as low as it could go. The Japanese have since taught us otherwise. But at the time we thought that 0 interest rate as low as we could go. That's when our Fed interceded in the market with what we now know as quantitative easing and started literally printing up money to buy treasuries and really came in and affected the entire supply and demand of the market. And we're still suffering the ramifications of that today.
So what you're essentially saying is this picture of interest rates, which are mountain shadowed in the back, is even worse than what we actually have, because you have, with quantitative easing rounds 1, 2, 3, Operation Twist, we have a problem with this line right here could actually have been much lower, but they didn't want to go negative.
Right.
Now, with quantitative easing, we had massive accumulations of treasuries and other debt instruments. Walk us through the purpose of that.
Sure.
And maybe the significance for us, because we've got a bunch of traders watching right now.
Perfect. And the thing to remember, as we're going to see in subsequent slides, is the yield curve is dynamic, constantly shifting according to supply and demand and other considerations. But what happened is, back in 2010, when the Fed funds rate got down to 0, and we still weren't seeing the type of economic growth we normally would have expected and wanted to see, that's when Chairman Bernanke introduced quantitative easing, which they did actually three rounds of here in the US for a total of $2 trillion. Now, what that means in a nutshell is our Fed literally created $2 trillion of new cash. And I know.
I've been trying to do that for a long time.
You and I would have a lot of trouble.
Even Rumpelstiltskin's going to go, damn, that's good.
You'd get a knock on the door if you and I tried this. So they did print up or create $2 trillion worth of cash, and with that cash came into the market to buy treasuries. And they literally told us which treasuries they were going to buy over that 3-year period. So think of it supply and demand. If the Fed is in as a huge buyer of treasuries, which they were, obviously what's going to happen is prices are going to go up and correspondingly yields are going to go down.
Right.
So, you know, the observation we started with is yields are very low here. Well, one of the reasons yields are so low is the Fed did a good job under quantitative easing of driving those interest rates down. What it also means, though, is the Fed is now a huge holder, the largest holder of treasuries in the world.
You know, and it's a unique attempt. I mean, we haven't really had anything quite to the extent with all the quantitative easing here in the U.S., but driving those yields down, that really makes money cheap and affordable. So as consumers, we look at this and go, that's okay. And honestly, I don't particularly have a problem with that. I think it was a good intent. I think it went on too long. I think it was it built up too big of a behemoth of asset holders out there, which we're going to talk about being the problem here. Since we have this image up here, let's just real quickly talk about the yield curve, since it's just about to get to where we are currently. I want to show you guys what happens when we have a rising rate environment. So here you guys can see back in 2004, 5, 6, as I'm moving the cursor, we had a normal yield curve, but they started to loosen or raise these short-term interest rates. And all of a sudden we get something like this, which is a flat yield curve. And then that led to an inverted, which led to a big crash. Well, we aren't at an inverted or flat yield curve, but we are flattening, meaning we are getting to the point where this short-term interest rate is being lifted and that long-term one is actually starting to drop a little bit. So you can see this curve here getting a little flatter than it was, let's say, 6 months ago or a few years ago, because they anchored that short-term rate at about 0. Now it's rising. And not that this is a problem yet, but it could be a precursor to something much bigger. Now, you had talked about the accumulation of assets, and this is a great picture here that shows under Greenspan, there really wasn't much. He seemed to be just Mr. Calm, collected, nothing big. And all of a sudden, Bernanke, it looks like an explosion here into Bernanke and Yellen. How does this pan out for that rising interest rate environment?
Well, what this accumulation of all of these bonds was the Fed's effort to not have interest rates rise. In other words, they came in and bought all of these treasuries in hopes of driving rates down. And what the chart clearly shows, and I like this visualization, the red part of the chart is under TARP, under Bernanke, our Fed came in and bought $800 billion worth of mortgage-backed bonds. This was the Fed bailing out its owners, the banks. And the red is the MBS. That's the Fed usually using their own balance sheet to buy bad mortgages. Then what you see is under Bernanke, the gray part at the bottom also starting to grow exponentially. That's the quantitative easing. That's the Fed having printed up all of this money to buy all these treasuries that now, if you look, the Fed's balance sheet, the amount of capital they actually have committed in the market is over $4 trillion worth of debt. If you go back to under the Greenspan era, it was less than $1 trillion. So the Fed's balance sheet has exploded as they've bought all these treasuries to try and drive interest rates down as successfully as they have.
So they buy all these, and it's interesting because they want to buy these to help prop the market up to make sure it doesn't collapse any further. And it brings to mind an old phrase you hear in all these movies, which is don't get high off your own supply. Well, at this point, it looks to me like we not only were high on our own supply, but we had other people who were our buyers.
Right.
And they're backing away. This one, to me, speaks volumes. There's really 3 major players in the Treasury Department. You're looking at the United States as being #1 consumer at this point. You have China and you have Japan, right? So if you know you've got your 3 biggest buyers out there, cool. That's great. You always have good customers. Well, these customers, including ourselves, have said what?
No more. Or not as much.
Not as much, right?
Let's say no more. That's an overstatement. That's right. Let's curtail it. If you look, as this chart clearly illustrates, the biggest buyers in the market are backing away. They're not as participating as much. As we said, during the summer of 2010, the Fed was in every day buying $13 billion worth of treasuries with money they had just printed. And the chart shows that growth in the green line. Now what we're seeing, though, is the Fed is not engaged in quantitative easing, so we're going to let that balance sheet diminish. So they're much less of a presence. And number 2 and 3 in the market were China and Japan.
Right.
Now China has become much less of a presence in the market. Some of that is for political reasons, quite frankly. The discussion of tariffs can't go unnoticed in this discussion. So China has said one of the retributions could be a backing away of their participating in U.S. Treasuries.
And not that it could be, it is.
Right.
I mean, if you look at this chart, we're all traders. Well, most people that watch this are traders or investors, and there's a phrase that says, the trend is your friend to the bend at the end. And you can clearly see in the red here, China, that bend, it bent in 2010. It looks like Japan bent way back in 2004, but they've been consuming less and less and less of our treasuries.
Right.
And then you have the wild card, which is our Federal Reserve, which conveniently enough is not a federal organization, but we can go different story there. From 2008, they were right around 7% of the consumption of debt holder for U.S. treasuries. And all of a sudden, we've shot up to 20%. Now we're unwinding. And here's even a couple more supporting images that Bill brought up, which I thought are just fantastic. Check out this one. Here's China. You can see really going back a few years. So 2010, they no longer were buying as aggressively. They're actually starting to sell off. And then this one is really what we found out more information about on Tuesday. The Fed basically came out last year and said, hey, we're telegraphing. We are going to unwind our balance sheets, not selling, but maybe let some of these things mature. And you can see that change happen in 2015. And then all of a sudden, 2018, we get aggressive selling off. What's happening?
Right. The Fed has decided that this whole inventory they have of all of these treasuries doesn't make a lot of sense going forward. So since 2013, when they stopped the quantitative easing, they were maintaining the same commitment in the market, meaning as a treasury matured, they would just reinvest the proceeds back into more treasuries. So as you can see on this chart, the balance sheet didn't change all that much.
Right.
Under the end of Bernanke's, under the end of Yellen's administration, she introduced the concept of the unwinding.
Right.
And what that now means, and this chart is starting to show, is as we go into 2018, as these treasuries now start maturing, they're going to literally let those treasuries mature, take the money back, as they would get like any investor would buy, and they're literally going to destroy the money. So just as we put $2 trillion of liquidity into the market by buying all these treasuries, we're now going to let them mature and unwind that balance sheet, but more importantly, make that money disappear.
I call shenanigans on that one. Come on, you're telling me that they created all this money, trillions of dollars out of thin air, and I'm now holding this money. I'm rich, and you're telling me we're going to get that money back, and we're going to say, let's just put that back where it goes.
That's exactly what I'm saying. And realize the Fed, as an organization, is responsible for money in circulation.
Sure, I get that.
So this is within their province and their domain of responsibility. So
maybe I'm just overly skeptical, but I tell you what, if you put a couple $1 trillion in my hands, you can pry it out of my dead fingers.
You want to see the smoke of the burning money,
exactly,
huh?
Exactly right, yeah.
Like the
Show me
Pope.
that stuff go away. Okay, so that paints the picture of where we are. We have an environment where we have had, we'll call it an artificially inflated bond market. We've had yields pushed forcibly, not the invisible hand of government, but the physical, blunt force of the government pushing it down and the Fed pushing it down to near zero for quite some time. We are now in a rising rate environment, right? The Fed has said we're going to have 4 this year. We've had 1. We had a rate announcement here recently, which basically said we're staying at 1.75. Thoughts on how many more we're going to have? Are we going to continue and have 3 more this year?
As per today, literally as per today, the market is pricing in an 80% probability that we will have 3 more rate hikes this year.
Okay.
And the Fed more specific. Oh, that's it, exactly. And the Fed more specifically has told us, data determinant, assuming the numbers come in where they expect to do 3 more rate hikes. You know, the point I think we need to stress here is the transparency that the Fed is affording us is literally unprecedented. You know, what they're doing here is unprecedented in terms of quantitative easing, now the unwinding. But more importantly, they are offering transparency. They're giving us prognostications as to what they think they're going to be doing up into 2020.
Right.
That's unprecedented transparency. So, you know, whether I think it or not is almost not the point. The
Right.
Fed thinks they're going to do it. And that's what's most important.
We've heard them say things in the past where they say, we're going to, you know, we get to full employment, we're going to start raising rates. That didn't happen. It kept dropping and dropping. So they might fudge the numbers a little bit. But I think it's clear, everybody watching right now, that we are in a rising rate environment. It has been rising for a year and a half or so, and it is going to continue to rise. So let's talk about the $50 million question. Well, it depends on how big your bank accounts are, or your trading accounts are. How do we position ourselves in an environment where we know rates are rising? 80% certainty we're going to get 3 more this year. I'm going to take those odds in any casino or any situation around the world. What do we do to position ourselves to capitalize? That's
a great question. But before we go there, if I could just add one more thing. When we talk about the Fed raising rates, they're going to be raising the short-term interest rate, the overnight rate. Going back to our yield curve discussion, what I think we're also going to be seeing, and again this is subject to discussion, is longer-term interest rates rising. Because what we were just saying is we've got the Fed, China, and Japan are no longer participating as much as they had. And it's like any other investment. If you have a lack of buyers, what happens to price?
It's going to fall quickly.
It's going to fall, meaning rates are going higher. But as importantly to this discussion, I think I have to mention, we have increasing supply of Treasuries coming into the market.
Which is just, now the equation gets a little bit more complicated.
But it's the perfect storm of higher rates.
It really is.
Because now the government is having to sell more debt than ever to finance the ever-burgeoning deficit. We estimate it's going to go to $800 billion this year. Those are bills that have to be paid.
Right.
That's money that has to be raised. So they're going to have to raise another $800 billion this year. So we've got even more supply coming into the market than ever at a time when the buyers are backing away.
So everything remaining even, we've got buyers backing away and saying, no, 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 we're going to curtail our spending. Okay, fine, I get that. That might add a little bit of a pressure. But now you have supply significantly higher than it's ever been. Could really create some major waves.
And the Treasury just announced yesterday that for the next quarter, they're going to be increasing just the quarterly financing by another $77 billion. That's on top of another 80-some-odd billion they did last quarter.
Right.
So they're having to sell more and more Treasuries to finance the ever-increasing debt at a time when the buyers are disappearing. So that's why we really are looking at a longer.
No, I'm with you. Okay, so
rates.
we could come up with a hypothesis that this is going to crash the markets, whatever. Let's not go there because that is purely speculation. What we want to go off of is fact and ways that we can preserve our capital or capitalize on this rising rate environment. So what are the key considerations our viewers should pay attention to for that situation?
And that's the mental transition that people need to do, because we have been in a declining or a flat interest rate environment for 10 years. So for 10 years, you might have reacted one way in that interest rate environment. Now what we're saying for the first time in a decade is interest rates are now on the way up. And that's a 180-degree transition from where we've been. And people need to wear that hat and understand that. And you're right, there's a discussion as to how that might impact other markets like equities and so on. But looking for the income investor, looking at the bond investor, in what is now a rising interest rate environment, there are two things that are at the top of the recommended list of actions to take. Number one is you might want to look at floating rate bonds. You know, and this is something that is not a big part of the U.S. market. Here in the U.S., most of our bonds are fixed coupon bonds.
Right, so you buy a 3% or a 5%, and that's what you're getting.
And that's what you're going to get for the life of that bond. I mean, we even call the bond market the fixed income market. But there is a small percentage of bonds that are floating rate. Now, if you think about it, a floating rate bond is a bond that resets its coupon every 3 or 6 months to reflect prevailing interest rates. So if you think about it, in a rising interest rate environment, if you have a floating rate bond, that means the income of your bond is actually going to go up. You'll benefit from that rising interest rate. Traditionally, if you had a fixed rate bond and interest rates went higher, you'd be penalized because the value of that bond would be going down. So it can take the negative and turn it into a positive. Investors really should be looking at floating rate bonds for their income opportunities going forward.
And I think the key point with the floating rate bonds is you're not going to kill it. You know, you're not going to get rich off this, but you're not going to be losing based off a condition you already know is going to happen. Rates are going to rise. Great. So if I am investing in bonds, so forget about the equity markets for a second. I see we've got some questions coming in on Forex. Let's just say you're in the bond market. You should be looking at floating rates versus fixed because they are going to move up. Now, are they more expensive? Are they different?
Well, and that's the issue. First off, to be very honest with you, there's not a lot of them.
Okay.
If we look at corporate bonds, there are some float product. Municipal bonds for tax-free income offer float product. The biggest market, though, in floating rate bonds is a product called TIPS, which is a government-backed security. So it's of the highest quality out there, which also means it's lower yielding. But a floating rate bond, by definition, is always going to give, in a normal interest rate environment, is always going to have a lower yield to reflect that opportunity that you have, that reinvestment risk. So yes, if you look at a fixed rate bond versus a floating rate in today's market, you'll give up some income by getting that floating rate feature. But more importantly, if interest rates do continue to go up, as we're surmising here, you will continue to benefit from that. The coupon will continue to increase.
You know, it's funny because as consumers, you've all experienced this type of discussion, but the exact opposite. I'll look at an example here. Let's say you want to buy a home. And if rates are really low, as they have been for the past 10 years, well, I'll call it 8, 9 years, you want to lock in at a fixed rate. Buying an adjustable rate mortgage when interest rates are at historic lows is kind of stupid because if all of a sudden those start rising, you're giving away money, right? Because the rates will be rising with current market. In this case, we actually want to have the floating to adjust to it. So we're kind of doing what the mortgage industry doesn't want us to do.
Right. You're the lender, not the borrower.
Exactly.
That's exactly right.
All right, so you got floating ones. So you had corporate bonds, and you had talked about TIPS. That's another form of these, correct?
Correct. Yeah, Treasury Inflation Protection Securities. Those are a floating rate government bond, and that is the largest of the floating rate products here in the U.S. So again, a TIP, a floating rate Treasury, would have a lower coupon than a regular straight traditional fixed rate because, again, you're going to enjoy that benefit over time. But in the TIPS world, that product has become so popular that the government now offers a full spectrum of maturities.
I saw a whole bunch of them when I went to the website.
Normally, when they first started off, they only offered a 10-year maturity and a 30-year. Now they offer a full spectrum from 2-year, 3-year, 5-year, 7-year, 10-year. So from a maturity point of view, you've got a much better, broader selection, which I think is in direct response to the appeal of this product. In a rising interest rate environment, you should be looking at this type of paper.
So interesting, and we're going to take a slight tangent here. So you have a direct result of a rising rate environment, obviously, is rising rates. Therefore, the floating products you mentioned, maybe some floating corporate, maybe some TIPS, could be very, very beneficial to you. Now, we do have a bunch of questions coming in here, and it's kind of on a tangent here, but we will address this. And the reason I wanted to keep this kind of as a tangent is because we don't know exactly. There are too many moving parts with regards to international markets and government rules and taxes, et cetera. But Rocky says, how will interest rates affect the Forex market? And I think it's important to remember here that if we have a rising rate environment, interest rates go up, more money is going to be buying U.S. dollars to capitalize on that rising rate. So what you end up have happen is the U.S. dollar will normally rise. Now, we could talk about who the Republican Party right now, and they historically have a down market for dollar in that environment. But if it does continue to rise and the dollar starts moving up strongly, that could be negative for the equity markets, right? Because you want the international purchasers of our goods and services are going to have to pay more for that, and they may actually go elsewhere for that.
Correct. And you know, the rising interest rate environment, for the reasons you just said very well, is not great for the equity markets, let's be honest.
No, it's not good.
Just like when we had quantitative easing here in the U.S. and they were driving interest rates down to these very unattractive levels, you can make the argument that one of the biggest beneficiaries of that, as your first slide showed, was a 300% increase to equity prices. I personally hate the word bubble. I think it's been so overused. But in terms of high valuations, most people do feel that one of the aspects of why the equity markets are where they are is that low interest rate environment.
Right.
And the dollar only adds the icing onto that discussion.
There's this argument that we're in a unique phase. We're actually experiencing a triple bubble right now, which, you know, for most people, you hear about a bubble and you kind of panic, go, oh no, now you've got 3 of them going on. I'm smiling with joy at the prospect, and this is going to sound absolutely horrible, of all 3 of these bubbles collapsing, because it presents opportunity. Whether I'm going to be going short, whether you are invested in TIPS and you're capitalizing on spikes in interest rates, whether you go long the dollar, short the euro, short the equity markets, there are a ton of different opportunities out there that we could dive into. The purpose of today was really just to say, look, if you're looking at the bond market, you're probably going to want to jump into a floating product. Just like I would advise you 6 months ago, lock in a fixed 30-year if you can, or a 15. Do not, under any circumstances, buy an adjustable mortgage right now. You're going to have higher rates. But if you're in bonds, you might want to look at locking those in. We have questions, and this is, again, talking a little bit outside the spectrum, but we got a few minutes here. And feel free to send in questions, guys. We're watching those as we go. As far as impacting international markets, so does this kind of show a little bit of weakness for the U.S.? I mean, does it start to boost other economies? We have Yoga here is one of our regulars, and he's in India, and he's saying, you know, how do you think this might impact India? I know that's a long ways away.
No,
but how,
when the U.S. sneezes, the world catches cold.
Right.
That's true in the world of quantitative easing. You know, because realize this daring experiment I keep talking about that Ben Bernanke brought into the market under quantitative easing was an academic concept, but nobody had ever tried it.
It works good in theory.
Right, and he had the courage to try it. I give him credit for that. But realize, since we have now stopped doing quantitative easing, by 2015, we had halted printing money. It was at that time that the rest of the world said that this might look like a good idea. So the European Central Bank started doing quantitative easing, Japan, the UK. They've all turned on the printing presses at a time when we have stopped on the printing presses. You know, we're further along on the curve here. So when we talk about the value of a dollar, obviously it's relative to something else.
Correct.
And as other countries are starting to print currency, their dollars or their currency is devaluing, the dollar's looking stronger. Now that we're entering into the tapering, though, the rest of the world is going to be looking at us saying, okay, now that we've put all this liquidity into the market, how good a job are we going to be able to do pulling it out again? So the world literally is watching the U.S. Fed as kind of the precursor.
It is.
As to what they're going to have to be doing.
You know, it's not to sound arrogant, but the U.S. is still the dog that wags the tail at this point. Now, that might be changing in future years, but, you know, you're right. When the U.S. sneezes, the rest of the world catches cold. So for yoga out there, it could certainly have an impact on the Indian markets. Now, currency sometimes, because the way they trade in pairs, there might actually be inverse relationships. Right. But remember, it could impact the overall economy. One of the best performing sectors has been emerging markets. Why? Because the U.S. has been doing amazing, so emerging markets do real well. Well, if our equity markets start to take a nosedive, which if you look at the math behind rising interest rate environments, a rising dollar, that historically is going to have an impact to the downside on equity markets, what do you think that's going to do to the Indian stock exchange? What do you think it's going to do for Russian stock exchanges or European stock exchanges? You might start to see that contagion catch. Now, that is all speculation at this point, but I'm going off of historical precedent, so I'm not just making it all up.
Yes, and now we had the equation, okay, as governments are looking to respond to economic crisis, quantitative easing is now a tool that up until 10 years ago nobody had ever tried.
Right.
So even looking at the rupee, the decision will be, does India want to do quantitative easing? That would obviously not be very positive for the rupee, although it would be positive for the Indian exchanges.
Yeah, and you might have problems. You have countries that are still haven't quite gotten themselves back on their knees economically. We could talk about the European Union, which is still pretty much at zero. What happens if all of a sudden we aggressively start to rising interest rates? What if we start having a problem? They might have even more economic situations. So that's all speculation. Again, we'll talk about that maybe in future sessions as that data and information starts to unfold and impact those specific markets. But right now, as of today, this exact moment, rates are rising. So protect yourselves out there. If you are nervous, if you are unsure, uncertain about what to do in the financial markets when these situations happen and we get market corrections, the simplest, easiest thing to do is just to go to cash and be more comfortable. Or, as we talked about today, you can buy floating products. You can buy tips. You can buy floating corporate bonds or other bonds out there, and that would help you protect yourself from that rising rate environment so you're not losing as these markets start to rise with rates. Now, as far as the equity markets, that's a whole other discussion, which we'll probably talk more about in future sessions. On behalf of myself, on behalf of Online Trading Academy, OT Academy, and Bill Addiss, we thank you so much for joining us today. We look forward to seeing you guys in future sessions, and check out other videos at otacademy.com.